Good afternoon. Good afternoon and welcome, everybody. I'm Marla Dan, past national president and current chair of the Legacy Campaign. I've been a proud supporter of Canadian Hadassah-WIZO CHW for 34 years, so I understand how important it is to ensure the future of CHW in Israel and in Canada. Legacy giving will provide financial security for our projects. It also ensures that all the hard work and progress we have made supporting education, healthcare, and social services can continue to benefit at-risk women and children for generations to come. The purpose of this webinar is to share best practices and thought-provoking ideas to structure a gift in your estate plans while minimizing your tax implications. A planned gift to CHW ultimately creates your philanthropic legacy. The impact of a gift can be life-changing, even if the donation isn't substantial. There is no minimum donation amount to be a member of CHW's Legacy Circle. This afternoon, we have three speakers: Daniel Goldgut, Daniel Glazerman, and Jorge Diener. Lisa Colt-Kotler, CHW CEO, will moderate a Q&A, so please type your questions in the chat function at the bottom of the screen. And the National President Elena Latsky will provide some closing remarks. So let's get started. Our first guest speaker is Daniel Goldgut, the CEO and co-founder of Epilogue, a platform that helps Canadians prepare wills and other important estate planning documents online. Prior to starting Epilogue, he spent 4 years in Toronto as a tax and estate planning lawyer. Daniel hopes that by making the estate planning process simpler and more affordable, he can help Canadians to get these important documents in place. So please join me in welcoming Daniel Goldgut.
Thank you very much, Marla. I'm going to share my screen here. Marla, if you can just give me a thumbs up if you can see that. Perfect. Okay, so when it comes to legacy giving, a central part of that is making a will. And it's one of those things that, everyone knows sort of in some sense what a will is, and probably that they need one. But for those that haven't yet engaged in that process, there's a lot of unknown and a lot of uncertainty there. And even for those who have, it can still seem pretty complicated and confusing. So my plan here is to do a bit of estate planning 101, just to walk people through sort of some of the basics around estate planning, and then to highlight some specific ideas around leaving gifts to charities in your will. Okay, so as Marla mentioned, I'm Daniel Goldgut. I'm co-founder and CEO at Epilogue. Before starting Epilogue, I was a tax and estate planning lawyer working in Toronto. My practice involved working with high net worth individuals and families, doing private company tax planning, business succession planning, and helping people with their charitable objectives. I started Epilogue in 2019 to make estate planning simpler, more affordable, and more accessible. Online wills are not right for everyone. And so most of what I will be talking about today is not related to Epilogue or to what you can do with Epilogue. This is just more broadly a discussion around estate planning and making wills. So as I mentioned, I'm a lawyer, and so the legal stuff I'll get out of the way early. So none of the contents of this presentation are intended to be legal or other professional advice. If anyone has any specific questions about their own particular situation, you're encouraged to speak to a legal professional. Okay, so the presentation will sort of go through in 3 parts. The first is just to talk about some of the basics around wills and estate planning. The second, more specifically, to focus on the distribution of assets. And then finally, some thoughts around legacy giving. Okay, part 1. So here's a statistic that a lot of people don't know, and every time I see it, it's interesting to me. So 50% of Canadian adults don't have wills. Another 15% have wills that they don't consider to be up to date. So around 65% of Canadian adults don't have an up-to-date will, which is pretty shocking for something that you would think everyone knows they have and everyone knows they need and everyone will do. So I'm going to assume, or maybe hope, that the audience here is doing better than the general Canadian public. But every time I see this statistic, it reminds me that it's important when I'm giving a presentation like this to really focus on the basics, because there may be a lot of people on the call who don't have a will, who intend to get one but don't have one yet. There may be people on the call who made a will, maybe when their first child was born, or their second child, or their third child, and it's something that they actually haven't gone back to look at in 20 plus years. So some of the stuff that I'm going to mention may seem, as I said, sort of like the basics, but I just think it's important, and that's really the place to start. So some key terms that I just want to get out of the way that are pretty central to the estate planning process. So the first is an executor. So an executor is a family member, a friend, or a professional trust company that you appoint to manage your affairs and carry out your wishes. So it's a central part of the will-making process is to pick this person, or as I said, professional trust company who can help. The role of executor is a challenging one. There's a lot of different responsibilities there. And so it's a really important part of the process. The term beneficiary, so that refers to any individual or charity that will be receiving anything from your estate. It could be money, property, or other assets, but that term beneficiary refers to someone who's receiving something under your estate. The term beneficiary is also used in sort of non-estate planning, so around insurance designations and registered plan designations. But here I'm focusing specifically on someone who's going to inherit from the estate. And then finally, a guardian is a person who is responsible for caring for minor children or pets after someone passes away. So one of the things that I think is important to mention here is when someone doesn't have a will, it's called dying intestate. And what you give up by not making a will is the ability to make these key decisions. So you don't get to decide who your executor is going to be. The distribution of your assets happens according to the rules of the province where you live. So you don't get to choose who your beneficiaries are. And specifically, I think it's important to mention here, charities are not included when it comes to the provincial rules about who gets your stuff. So you've completely given up the opportunity to leave a gift to charity. And when it comes to minor children and pets, you've also chosen not to name a guardian. Okay, so now let's get into sort of more of the central estate planning piece. So what is your estate? So your estate is made up of a collection of assets and things that you own. So a few things to note: your estate does not include any registered accounts for which there's a beneficiary designation to an individual. So if you have an RRSP or TFSA and you've named someone as the beneficiary on that account, the assets in that account are not going to pass through the estate. They go directly to that individual. The same is true with life insurance policies. If there's a named beneficiary, it goes directly to that person. Jointly owned assets. So if you own a house jointly with a spouse, for example, and you pass away, the house passes by right of survivorship automatically to the joint owner. That's not an asset that's going to come through your estate. So what does your estate include? Well, it's everything else. So it's bank and investment accounts, interests in corporations and partnerships, accounts and policies that have no valid designations, or ones where you specifically named the estate to be the beneficiary on that policy. Real property where there's not a joint ownership, so tenants in common or where you're the sole owner of the property. Household items, so jewelry, art, cars, things like that. And finally, digital assets. So, cryptocurrencies or NFTs or any other thing that fall under digital assets. Okay, so now that we've got an idea of sort of what is included in your estate, so it's all of those things that you own, all the things that make up your assets. How do you distribute them? So if you see the blue part of the pie right here, the very first thing that's going to happen is that debts and taxes and funeral expenses get paid. So before anything can be distributed out to the beneficiaries, your executor is going to be responsible for satisfying any of your debts. So, credit card bills or loans that you have that are outstanding. They're going to pay your taxes. So any income that you earned in the year of death, there's going to be a terminal tax return that your executor is responsible for filing. So those taxes need to get paid, and taxes on capital gains arising from your death, and any funeral and related expenses. So those are removed from the pie before we can start paying anything out to your beneficiaries. So the next part of the pie that's going to go out is specific gifts to people. So in your will, you can choose to leave specific gifts either of cash. So I leave $10,000 to my friend Jason. You can leave property. So I leave my baseball card collection to my niece Teddy. So you can leave items or cash to anybody. Some things to remember here is these things come off the top. So these are sort of the first level gifts that are made. So it's important to make sure that if you are creating a will that leaves specific gifts, that those gifts are not more than the total value of your estate. Because if they are, then those are the only things that are going to get paid out because they get paid out first. Next point I'll make here is the timing of the gift. So you can decide that something is made immediately on your death, or in the case of someone who has a spouse or partner, you can coordinate in your estate planning and decide that the gift should be made on the death of the survivor. So there's some flexibility there when it comes to gifts to people. Up next is specific gifts to charity. This works much in the same way as gifts to people does. So you can decide to make gifts of cash or gifts of property or other assets. And the same considerations here, you can decide that that gift should be made immediately after you pass away. Or in the case of spouses, you can decide that the gift should only be made once, and that is on the death of the survivor. So that's something that when I was practicing was pretty common to see. Couples would plan together, and oftentimes it's, you know, in some cases it's related. There's a tax deferral on the first death and everything goes to the spouse. And so you sort of get the full benefit of that tax deferral. And then the idea is that you can maybe make a larger gift together on the death of the second spouse, but that doesn't mean that's the only way to do it. You can be a combination of the two, where you know, some amount of the gift is left on the death of the first spouse, and then a different size gift is left on the death of the second spouse. The next thing is personal articles. So this, you know, art, cars, jewelry, household goods, these get dealt with in your will. You can choose to leave those to specific people. As I mentioned, that sort of falls into the specific gifts that I mentioned above, or you can deal with them in bulk to say, I leave all of my personal articles to my spouse, or I leave all of my personal articles equally to my children. And then there would be some mechanism for them to decide who gets what and in what order. And that brings us to sort of this last section here, which is the residue. So at this point, the debts and taxes have been paid. Those came off the top. If you've chosen to make specific gifts to people or charities, those get paid as well. Personal articles get dealt with. And then this orange section is the residue. So this is everything that's left. When it comes to the residue, here again, you can make decisions about how you want the residue to be distributed. So you could leave everything to a spouse or partner. You can split everything equally between adult children. You can leave it in different shares or different percentages to friends or family members or whoever you want. It's common here to name contingent beneficiaries. So if you've chosen to leave everything to your spouse, it's important in the will that if your spouse predeceases, that you provide for that. So if your spouse predeceases, that you would leave things sort of to either a different individual, a different group of individuals, a charity, a combination of the two. And that's to deal with the residue. So that's how your assets get distributed or who your assets get distributed to. One other thing that is important to mention here is that there's also flexibility in terms of when the beneficiary gets the money. So if you think about individuals, you can either leave gifts to individuals to be left outright, that someone gets it right away and they have full access to it. It's theirs to do whatever they wish. Or you can leave something in trust, which means it's theirs, but there are some provisions around how they get it, when they get it. So I'm not going to get into too much detail there about things that are left in trust, but there's some important things to think about in terms of, as I mentioned, the treatment of income and capital. So how much are they getting, when are they getting, and from where?
Hi, everyone. I think we have a bit of a technical error here.
Just gonna say-
Looks like, yeah, Daniel's coming back on. So just
Okay.
hang on a sec.
Okay.
And there you are.
Okay,
I think I cut out.
yeah. Okay,
Am I
you're
back?
back. Yeah,
Okay, but I'm still sharing or not anymore?
no,
Okay. So let me do that. Hopefully, I think I've got 2 more minutes of time.
yeah, no, you're good. You've got a few more minutes.
Okay, perfect.
2:26.
Okay. So
Okay.
I'm not sure exactly where I cut out, but I was talking
Right
about.
there, right
Okay.
there,
Yeah,
legacy giving.
perfect.
Yeah.
Okay. Okay, so this is the final part of the presentation around legacy giving. So there's 3 points that I want to touch on when it comes to charitable giving and wills. The first is that you can make a tremendous impact on the causes you care about. So for people who are monthly givers or annual givers or giving one time, let's call it the pool of funds that you're pulling from to leave those gifts are funds that are available to you during your lifetime. And so when someone passes away, you've got significant assets like a house that may be sold after someone passes away. So there's this sort of a new pool of assets or an increased pool of assets from which you can draw, and gifts and wills can take advantage of that. So leaving a percentage of your estate, as I think Marla mentioned at the beginning, even if that's a small number or a small percentage, the value of someone's estate can be really significant, right? So there's an opportunity here to make a much bigger impact on a charity, maybe than you believed you could have made during your lifetime. The next part is tax advantages to including a gift in your will. So I'm not going to get too deep into the details of sort of, the Income Tax Act and how those tax advantages work, but there's a few things that are worth mentioning. So one is that there's some flexibility that you get in tax treatment. So again, without getting too far into the weeds, during someone's lifetimes, the tax credits that you can get are up to 75% of your taxable income. After someone passes away, it goes from that 75% to 100%. Tax credits during your lifetime can be used in that same year. And after someone passes away, it's both in that year and in the year prior. So there's some additional flexibility. Another important thing to mention is that there's certain assets for which you would get there would be a nil capital gains inclusion. So marketable securities is one of those examples. So a gift of marketable securities. So if your executor satisfies a gift in your will through marketable securities, there's additional tax benefits to your estate in that you're not also paying tax on the increase in value on the marketable securities. And then finally, the last thing I'll mention here is that gifts and will can be extremely flexible. So they're flexible in a number of different ways. Some of the things that I had mentioned earlier. So you can choose to make it a dollar gift, or it can be a percentage of the residue. So if you want it to be a fixed number that you know today, you can choose that number and make it. If you're more comfortable with a floating percentage, that's an option. It can be made by cash or in kind. So again, it can be property that you own. It can be marketable securities. There's different ways to satisfy the gifts. The gift can be directed or undirected. So you can choose a particular initiative or a particular area that you want to focus on, or you can just leave it to the organization to their greatest need. And you can choose that it can be immediately on your death, or in the case of a spouse situation, it can be on the second day. So there's a lot of flexibility. It's not that if you leave a gift in the will, there's only one way to do it. There's a lot of different ways to do it. And so for people who are interested, I would suggest that you start having some of these conversations to understand maybe one of them is a much better fit than the others. So that is the end here of my part of the presentation. So I haven't touched on the additional flexibility that there is in terms of planned giving outside of wills, and that's where Daniel Glazerman will hop in. But I am staying here, and so if anyone has questions, please send them through the chat, and then hopefully Lisa can ask them to me, and I can answer them a little later.
Okay, that's great. Thank you, Daniel. It was really thought-provoking, and I like the statistics that you threw in there. So definitely, I think about some of your questions and definitely write some of them down. Is definitely informative. So I want to move on, and we're going to go to our next speaker, another Daniel. Our next speaker is Daniel Glazerman. Daniel holds the Chartered Investment Manager CIM designation and is a certified financial planner professional. Since joining Evans Investment Council in 2011, he's been committed to understanding the unique circumstances of each client and prides himself on his hands-on approach to working with clients. He presents clients with a very focused, methodical, and professional approach to private wealth management, tax, and estate planning. He's also an active member of the Estate Planning Council of Toronto. Please join me in welcoming Daniel.
Hi, thank you very much, and welcome everybody today. I look forward to sharing some information with you on some giving and giving tactics that I think will help and help you to be able to maximize charitable giving and minimize taxes. Further to Daniel's presentation, unfortunately, I just had a client's brother who passed away intestate, and I can assure you that it is not a circumstance that you want to be or your family to be left with. It's very messy and what have you. Just on the disclaimer, I am not a lawyer, but Daniel is, and he uses the similar disclaimer. This presentation is for information and illustration purposes only, and I'd ask that you don't rely on the slide material as it's maybe incomplete or inaccurate without additional context that's very specific to your situation and or further information provided in the Zoom presentation that is not part of this slide deck. This presentation is not to be constructed as legal, tax, or accounting advice. You should consult your lawyer, accountant, financial planner to discuss your individual circumstances. And that is, I'm not going to go deep into my background, but understanding one's personal situation is very critical in planning, in legacy planning, and tax planning. It's not a one-size-fits-all. It is very much unique to everybody. Everybody's got different circumstances, tax situations, philanthropic goals. So today is a very general topic or discussion, but with some very salient points that everybody can use, or at least use as a provoking conversation with your professional. In this world, nothing can be said to be certain except for death and taxes. It's not an easy conversation to have, but we all know that at some point we will pass. As Morgan Stanley wisely said, you must pay taxes, but there's no law that says you have to leave a tip. So what we like to do is be able to provide you with some tips and tricks and just some commonsensical approach to looking at this from a very practical standpoint. Motivation to give, and despite my presentation, generally speaking, the motivation for give is not tax savings. It's generally community impact, the ability to give back to the community or have a very passion or cause that's near and dear to you and your family and something that you want to support. What I would say is that tax savings is the icing on the cake. And really what it'll allow people to do is to be able to give more to that cause, leave more to your family and less to the government. So unless you really have a desire to pay more taxes, which I don't think anybody does, or most people don't, then looking at this and looking at some of the tips and tricks and ideas is just in your best interest, and obviously in the charity's best interest. What is a gift? And a gift is just simply a voluntary transfer of property to charity. That gift could be to an individual, but the property must have value that can be clearly determined. And this still precludes a receipt for donation of services. But today we're going to talk about really items, possessions, cash, life insurance, stocks, bonds, property, anything that would be a hard item. So I'm going to try not to get too technical, but I do want people to understand that in Canada, we have graduated tax rates, and we also have, with donations, that we get tax advantages based on our tax rates, both federally and provincially, and based on what your income is. And income is from all sources. So on the first $200 and then the remainder of dollars, and we're going to talk really about the remainder. Most people are, generally speaking, making $18, $36, $72 donations throughout the year to simple causes, it gets you past the $200, and we're going to talk about the rest. So at the highest level, so for people that are making over $221,000 a year, federally, that tax credit is 13%, and provincially it's 17.41%. If you're making less than $221 a year on net income, it's 29% and 17.41%. As Daniel alluded to, an individual can claim up to 75% of their net income while they're alive, and 100% of their income when they pass. And there are certain situations, specific situations, where you can actually donate 100% in the years that you're alive. But we'll just deal with the 75 for now. Donations can be used in your current year or carried forward for up to 5 years, and that married or common laws can pool their donation receipts to maximize their tax credit. So my wife and I, we both donate to different charitable organizations. At the end of the year, we pool together what those receipts are in order to maximize that. Most of my presentation today is by way of donations of individuals, but there's also donations by corporations. So a lot of people have private corporations, which is classified as a CCPC, and there are advantages of donating out of CCPCs as well. I'm not going to get deep into the weeds, but if you do have a professional corporation, I would highly suggest that when you're talking to your accountant, that you look at or ask them, does it make sense for me to make this donation through my corporation, or does it make sense for me to make this donation personally? And they should be able to help guide you. It's a lot of what I do when I'm looking with clients or investigating with clients and then pulling in their accountants to making sure that we are giving in the most tax efficient way. And that's part of that discussion. So what I've done is I've given you a maximizing your gift during your lifetime. And as Daniel suggested, that you could make donations of cash, donations of security. So I'm going to assume for a moment that most of us have a portfolio, and in that portfolio that you would have mutual funds or stocks, and those stocks over time, hopefully if whoever's managing, they've done a good job, they've appreciated in value. When you sell stock, obviously you have to pay tax. So rather than selling stock and then making a donation to your charity of choice, you can actually donate the security to the charity, which would then eliminate the need for you to pay that capital gain and the taxes on that capital gain. So it's going to amplify your total donation. So in this example, what I've shown is that you either have a stock, you sell the stock, then you make the donation, or you just donate the stock in kind to the charity of choice. The difference on that $10,000 donation is $1,606 to your benefit if you in fact donated an appreciated share with a similar cost base with the similar donation amount. And so that will vary a little bit based on what your cost base is, but the donation tax credit on both instances at the highest marginal rate is 50.41%. The difference being is the individual does not have to pay the capital gains tax on that donation. So a lot of you may have had just Canadian bank shares that you've held for a very, very long time. At some point or another, you are going to have, or your estate is going to have, a tax liability. So you can do this while you're living and mitigate some of that tax liability and maximize the donation. Another example, what I've shown is some individuals have had stock and they've sold the stock in a given year, but they've had some other stocks that maybe haven't done as well. So I've used an example of the client having Apple shares. They have a $20,000 gain, but they're sitting with some Peloton shares that they're underwater on. So they can donate those Peloton shares, mitigate some of the tax payable on the crystallized realized gain that they had with those Apple shares, mitigating the tax, still getting the donation credit, and then still in this example, there's credit left over to be carried forward. So you can either donate that stock in kind, the loser, or just sell the loser, the stock that you're down on, and make that donation for the equal value. So what it really does or entails is for you to sit down with your professional advisor, look what you've realized in gains, what you want to make in donations, and how much you've got in unrealized losses in order to mitigate the taxes. Other opportunities for making gifts during your lifetime is give some insurance. I do not sell insurance, but I work with a lot of different insurance advisors that do sell insurance, and there is excellent opportunity using insurance to be able to make amplified gifts that are very beneficial for both the charity and for you. So you could buy a policy, assign it to charity, and that annual premium becomes a charitable donation for the death benefit going to charity. You could buy a policy, make the estate a beneficiary, and then will that the charity the amount of what that insurance proceed would be after it's arrived in your estate. And this works well for individuals that will have a significant tax liability on death. Or do you have a policy that you no longer need or want that has value? And so that fair market value of that policy, if it's no longer important or necessary for you, is that you could get a charitable tax receipt for the fair market value of the policy rather than just canceling the policy. Again, this would require looking at your insurance needs, speaking to your insurance advisor, and then identifying if there's opportunities within there to be able to make gifts of sorts. The next concept is, do you have a large RRSP or RIF? So an RRSP or RIF is obviously a tax deferral, but it also, for a lot of people, it can be a ticking time bomb. And what I mean by that is, if you're married, when you pass, your RRSP or RIF will then go to your spouse or your common law. The issue is when that second passes, that RRSP or RIF, and generally speaking, it's the RIF, if you live past the age of 72, is all going to go into taxable income. So I've got clients that have multi-million-dollar RIFs, and at some point when they pass, that they will end up having to pay a significant amount of money to the government, as it's all going to be taxed at 53%, or just over 53%. So I'm going to give you an example of a lower income, meaning someone that doesn't have a huge income, but has a very sizable or a fairly sizable RIF. So they've got income of about $60,000 a year. They withdraw $10,000 from the RIF at just under 30%, causes $2,900 in tax, but they get a 46.41% charitable receipt, meaning that they offset that $4,641 against their income. The charity receives $10,000. Now there is some holdback, and I'll explain that after. The taxes paid would have been $2,965, so they would have to top up the difference. But then the client receives a $4,600 tax credit to offset the taxes, and then has an additional $1,676 of a tax credit to be used against other income. So if you don't need all of the money that you're living off of your RIF or such, that this is a good technique to either do it with tax savings or with very minimal amount of tax, depending on what your tax bracket is. And again, that has to be looked at. So taxes payable on death, I just explained the RIF situation, but with married or common law couples, all of their assets will pass from one to another while they're alive. The big issue comes when the second passes. And at that point, everything is deemed to be disposed of. So you've got a RIF, you've got a trading account, a taxable trading account. You've got all sorts of other assets that now make part of your estate. The book value versus the market value. So what it costs you to what it's worth is now a taxable event. And if there's ways to mitigate that, I'm going to show you next on how to deal with that. So an example that I use with just the RIF. In another client situation, I had a family with 3 children, and the father was in his 90s and still had a very sizable RIF, as well as other assets to his name. What we did was we designated the RIF to a charitable organization, and he, at the time, whatever was in his RIF would have been 50% taxed. The charity got 100% of what was in the RIF. So in this example, Mrs. B had in her RIF $700,000. She passed away. So on the date of death, it was deemed disposed of and is classified as taxable income. At the highest marginal rate, she would have had to pay 53, so $374,500 in taxes. Alternatively, she could have donated the entire RIF and got a $700,000 into a charity or charity's hands, 0 tax payable. Now, there is from that, you know, your heirs would have not gotten the $374,000, but in this situation, a charity would have received $700,000. So it all depends on what your circumstances are, what other assets that you've got to leave to your children or friends or family or whoever else you're leaving to, and what assets make good sense. How to reduce taxes and maximize your death benefits or benefits to charity. On your death, 100% of your net income and for the previous year can be donated to charity, and that can be made up in all sorts of different items: cash, securities, properties. Again, we talked about the RIF. We can also do that with a non-registered portfolio, using the example of, again, you've got some bank stocks, you've held them for 20 or 30 years. On the last to die, there is going to be a significant tax liability. What you look at, or what you want to identify, is how to reduce the tax and how much to give to charity, and the possibility of eliminating as much tax as possible. And that amount could be set up in perpetuity. What you can do is that you can leave it endowed or non-endowed. So for example, with Hadassah, if you left it in an endowed or a non-endowed fund, so it could be a legacy gift, you could leave it to multiple charities by designating it to multiple charities, or you could set it up as a donor advised fund and then use that donor advised fund to support the charities of your choice. So there is a lot of options, and everybody's unique circumstances are different. But I think what you want to do is you want to kind of dig into it and understand where you have the best use of your dollars pertaining to the investments that you've got. So talking about death and dying can be very uncomfortable, but as I said, it's unfortunately a part of life. But with a little bit of planning, you can reduce lifetime tax payables and then minimize the tax payable and maximize your giving. So that's the end of my presentation. I just want to thank everybody for their time.
Thank you, Daniel. You have definitely started a great conversation and thought-provoking information today, both Daniels. So we really appreciate that. I think everybody's going to be phoning their consultants afterwards. So we're going to move on, and we've got our last speaker. So our last speaker is Jorge Diener. He is currently the executive director of Hadassah International. Over the years, his professional career has focused on training, consulting, coaching, and network building with global leaders. Jorge has developed innovative models that enable grassroots movements, well-established NGOs to grow their support through human and financial capacity building. He trained, coached, and consulted for over 1,000 leaders and managers of all different backgrounds and sectors. A sought-after keynote speaker, Jorge has presented at international events, as well as providing consultancy and advice on communications, strategy, and fundraising to NGOs and governments across the globe. Please join me in welcoming Jorge.
Mute myself. Thank you, Marla. And it's a pleasure being here and representing Hadassah International and the Hadassah Medical Organization, and showing some of the practices and examples of how legacies have been able to transform the lives of so many people. I think there is something about the decision of making a legacy that is about transcending beyond the time we live and leaving behind an impact that will affect in a positive way the lives of many that we won't be able to see. And I think this is one of the most generous things that we can do, is to make sure that what we do will be still remain once we are not around. And it's not just as something that will remain as our own legacy, but also as a legacy for our children, our grandchildren, and all the other people that will see us as an example. And Hadassah Hospital has over 110 years of legacy tradition. You know, we have been built with legacies that have enabled our hospitals in Jerusalem to flourish. And when I made some kind of research about the people who give legacies to Hadassah, it's very clear that the legacies are connected to the values behind an organization. Hadassah Hospital is about innovation, it's about tikkun olam, it's about humanitarian work, it's about coexistence, and it's that cocktail, that mix, that makes Hadassah hospitals in Jerusalem such a unique opportunity to do something that will last and make an imprint in the landscape, not only of Israel and Jerusalem, but the landscape of health and medicine around the world. And what better way to leave something behind that will be transformative, such as contributing to the finding of cure, to the finding of solutions, and to the resolution of conflicts in the middle of a very conflicted city at Jerusalem, when you have Arab and Jewish and Muslims and Christian doctors, nurses, personnel working together, not just because they work in the same place, working together for the common cause of using innovation to find solutions for humankind. And a few examples that will speak to that, why people who gave, who decided to leave a legacy to Hadassah were visionaries. At the end of the day, somebody who leaves a legacy has a vision of somebody that will transcend. And one of the best examples I have is a man from the United Kingdom called Latetreu. Latetreu left a legacy, and when we were planning to build a new surgical tower at Hadassah in Kerem, the biggest hospital project in the Middle East in the last 20 years. And his decision was to leave a legacy for the construction of one of the 13 operating rooms that were going to be built in the underground -4 floor, a bunker that protects every person being in the middle of any surgery, protects from being having their operation interrupted in the middle of a nuclear, biological, or chemical attack. Something that we thought, was theoretical, but more and more, the war shows us that anything can happen. So we built that with that in mind, but also understanding that we might need that space to evacuate the 1,300 patients and families and doctors if something like that happened. And when he left that legacy, he was thinking about the impact. That operating room will help hundreds, thousands of people have the level of surgery and with the new technologies that we're going to be incorporated into that OR and benefit from that. And what happened is that after he passed away, and we could use those funds to build the operating room. That operating room became a dual robotic room. Dual robotics is when two robots are used or work at the same time. One does the imaging and the other one does the procedure, specifically in this case for the repair of a broken spine. And these two robots work together with the technology developed at Hadassah. And the first operation that they did, first surgery that was done by the doctors who, of course, used these two robots at the same time, was done with a construction worker from Jerusalem, a poor a person in the city who, of course, couldn't afford, but the health system in Israel allows that person, and with the technology and the operating room that Latetreo left in his legacy, was able to have his life saved and left the hospital walking 1 week later, when people thought that, he wouldn't survive and be paralyzed. And like that, we can count examples from so many places. Miss Weiss, a woman with no children in Germany, in Munich, who her connection to Hadassah was that she saw Hadassah in the news. She heard about the hospital, she heard about Jerusalem, she heard about the things that were happening, and she decided were happening in the hospital. The stories about the Arab doctor with the Jewish doctor that were working together during the terrorist attacks and treating both the victim and the victimary, and they were saving all lives together. It's so powerful stories. And she just left a legacy that we opened 3 months ago with $2 million for the rehabilitation center that we are building right now in Hadassah in Mount Scopus. But then, you go to those stories that help an organization grow. And Hadassah International organization I manage today was created about 40 years ago, next year, 39 years ago, by the vision of an Hadassah leader called Bernice Tannenbaum. Bernice Tannenbaum, who was the national president of HWCOA in the United States, understood that for Hadassah hospitals to become stronger, there was a need to have partners around the world that will support the hospital. And Bernice Tannenbaum left a legacy that basically was meant to support young leadership. And we started this year a program thanks to that legacy. It's 40 years. It's like from slavery into freedom would count if we were in Pesach. And she left that legacy. And now 10 young people, entrepreneurs between 30 and 45 from different countries around the world, met 2 weeks ago in Switzerland, and 50 new young leaders, entrepreneurs, and as we call it in the spirit of the legacy that she left, we call them not the leaders of the future, we call them the leaders of the present. Young leaders who are already leaders in their private activity, in their private business, are the leaders that now are part of the leadership of not just of the Jewish world. We have also some Arab members of the group, a couple of doctors from the hospital. It's a coalition of young leadership to heal the world from Jerusalem and with this global network. This is the kind of impact that anybody living a legacy wants to leave behind, something that is transformational, and something small also can make a difference. Because, and I will end with Erica Marks, because Erica Marks from London, social worker who's still alive, but she decided that now that her 4 kids became young adults and are independent, she decided, because she loves Hadassah and she loves this unique mix that I mentioned at the beginning, she decided that she will leave part of her legacy to Hadassah. Doesn't matter how much is that, because every piece of a legacy can transform the world one piece at a time. So having said that, I want to thank you for giving me the opportunity to share this. And I encourage anybody who has the ability, and everybody has the ability, to go into a legacy program, because there are things we can do while we're here, but there are things we can leave behind that will touch so many lives moving forward. Thank you.
Thank you so much, Jorge, for illustrating for us these wonderful examples of how a donor can make an impact, not only while they're alive, but after. And, you know, as part of the CHW family, a cause that's resonated with you throughout your lifetime, you know, we want to make sure that our families are looked after, and that includes CHW as part of your family. So on that note, we're going to open the floor for questions. There are two opportunities. You can either type your questions into the Q&A function at the bottom of your screen, or you can use the chat function. I will read out the question and then ask any of our panelists if they want to jump in and provide an answer. Feel free to throw out a question. Don't be shy. I do have a question, actually. I'm gonna direct this one to Daniel Golgut. My question is, if someone's already created a will and now they want to make a charitable allocation in their estate planning, and it's expensive for a lot of people to go back to a lawyer, rewrite their will. I know there's something called a codicil. I don't know if you've touched on that, but maybe you could just explain how someone amends their will to include a charitable gift so that we can ensure that our donors have the easiest pathway to do this. Can you maybe touch on that for us?
For sure. So if someone has an existing will, I mean, the first thought or the first recommendation would be to go back to the person who drafted that will. So, you know, there's a few considerations. One, if that will was drafted 30 years ago, it might be time for a new will. So in addition to that change of adding a charity, there's probably a number of other things that are worth doing. And so that's not really the case where a codicil would be a good fit. Just for everyone's benefit, a codicil is a document that amends a will. So it's a document that might say, I created a will on such and such a date in the past, and I want to change that will by replacing paragraph 4A with new paragraph 4A. And so the idea is that it's a sort of, it's an amendment to an existing document, and then you keep the codicil with the will. So in my practice, it was more common not to do codicils, because when people came back, it was easier to follow and track if you just made a new will. Even if you were just making one change, you would just make that change. The codicil still needs to be signed in the presence of two witnesses, so you're not saving much by creating a sort of a shorter document. So going back to your question, so if someone has a will, the first thing is think about, how long ago did you do your will? Is it just this single change that needs to be made, or is it worthwhile to go and look through your estate planning and see if there's other things to do? If you originally did with your will with a lawyer and you still have an existing relationship, that's a great place to start, to ask that lawyer if you can come in and have a discussion about making this change or more changes. I mean, when it comes to online wills, which is what Epilogue does, if you have an existing will with Epilogue, you could go back through, update it, and include a charitable donation in your will. If you have an existing will and you're looking to make a completely new will, and whether you made your original will with a lawyer or you did it on your own or whatever it is, and now you're looking to change and sort of make a new will a different way, online could be an option. But like I said at the beginning, it's not the right choice for everyone. There's certain sort of people that it's right for and certain people that it's not. So I'd probably stay away from the codicil, look back at the existing will, figure out what changes you want to make, and then that will dictate a little bit who you should go back and speak to and what process you should follow.
Okay, great. Thank you so much. One question that's been raised is, when you establish a donor advisory fund, can you explain how the tax receipt process goes for the initial dollars invested in the fund? So I throw that out to either of the Daniels.
I can answer that. So it's immediate. The benefit of a donor advised fund for a lot of people that set them up is either A, they don't know what charity they want to support immediately, but they know that they've got an event, a taxable event that they want to try and get that tax receipt for. So they make that donation to the donor advised fund, park the funds there, get the charitable receipt, and then they can decide when and to whom they want to donate those dollars to. The other option, or the other thought, is that is the donor advised fund then allows them to make significant charitable donations to various charities, and it's just what I would call a one-stop shop for where those dollars went, but they can then be distributed to any registered Canadian charity.
Okay, great. Next question is, can you explain about trusts, the advantages, and when one should think on establishing, I guess, a trust? I go throw that out to you, Daniel.
Well, I'll jump in first, and Daniel, if you want to go after, I'll just, there's all sorts of different trusts. And so depending what the nature and the need of that trust is, but I'll just take it from let's take Mrs. B and Mrs. G are now in a second marriage. They're together, and they've both got children from separate lives that they had before. A lot of times in one's estate, they would have that Mrs. B or Mr. G would get part of the income off of a pool of capital, but when that second person dies, then that money then would be distributed to their family members or to their immediate family members. So it's a way to segregate and protect a certain amount of assets or specific assets, so that when a second marriage would arise, that's certainly one application. Or in some instances, people have children that are not capable of handling large sums or any sums of dollars, and that they need to have money put away in a trust, so that when someone does pass, that they could then disperse that money over periods of time to their children. A lot of that would also be for minors that are not able to accept the money or take the money at a certain period of time. So trusts are just a very, and I'll let Daniel jump in a little bit more on trust, it's just a very specific planning technique, depending on what the situation of the dynamic of why that trust needs to be introduced. Daniel, maybe you want to add to that as well.
Sure. So I'll start by saying trusts can be complicated. There's an entire law school course, a year-long course devoted to it. So it's going to be difficult to sort of answer it here, but I think there's two important things to know. So what is a trust is sort of the first question. So a trust is a legal relationship that essentially has three parties. So there is a contributor, someone who is sort of putting money into the trust. There is a trustee, which is the person who is responsible for managing that money. And there is a beneficiary, which is a person or charity who is receiving the money. So what setting up a trust does, it separates legal ownership from beneficial ownership. So you've got the trustee who's responsible for managing and investing the money, and then distributing that money out to the beneficiaries of the trust. So with that context, there's two different kinds of trust. There's more than two different kinds of trust, but there's two different categories of trust. So one is a trust that you make while you're alive. So someone can settle a trust while they're alive. They can put that initial contribution in. So, if you think about, some of the movies that you see of, sort of wealthy families and wherever they are, and that sort of trust fund concept, that would be one where potentially you've got someone who is putting, the matriarch and patriarch are putting the initial money in the hands of a trustee. So someone who's responsible for then managing and then distributing it out to the kids or adult children, whoever they are. So that's one route, is creating a trust while someone's alive and using that. And as the other Daniel mentioned, there's some tax benefits potentially to doing that during your lifetime. And then separately, there's creating trusts. They get created in your will. So you can leave money in trust for someone in your will. Those trusts don't get created until that person passes away. And there's different considerations that go. So for sure with minors, anytime money is going to a minor under a will, it's likely being held in trust. And there's certain provisions that govern how that money gets distributed and stuff like that. So it's sort of a long way of saying that that is something absolutely to speak to a lawyer about. If you've got any sort of real questions about either setting up a trust today and understanding what the benefits of that decision might be, or understanding when it comes to your will, what kind of trust would make sense to be setting up in your will.
And just on that note of trust, I've heard the word testamentary trust being used before. Is it the same thing or something different?
That's right. So the term inter vivos trust refers to a trust that you create while you're alive. And the term testamentary trust refers to any trust that's created as a result of the death of the testator. And the testator is the will maker. So that trust, you set out the provisions in the will, but the trust doesn't come into existence until that person actually passes away.
Okay, thank you. Next question is, if your lawyer who drafted your will passes away or retires, is it necessary for someone to have a new will drafted?
No. So it has no bearing on the validity of the will. So if it's time to update your will and your lawyer's retired, you'll need to find a new lawyer. But if you recently did your will and it reflects your current wishes, just because your lawyer has retired or even passes away or any of those things, the document that you have with you that's been signed is still a completely valid, legally binding will.
Lisa, I'll add one thing that I think is important for people to understand or to just make note of. A lot of children, we'll say, just children for this time being, don't know where their parents' will is and don't know which will is the most valid will. So I always say, you don't want to have a treasure hunt for somebody. So organizing one's estate or having things well organized, knowing where powers of attorney are, where the will is, what instructions were to be left, who to contact. So there's a lot of organization that should go in. A lot of families don't do what I would say the necessary dotting the I's and crossing the T's. And when a death happens, especially suddenly, it's a very stressful time. And people are a little bit in shock as to what to do and what needs to be done. So what I try and communicate with clients, friends, anybody that asks the question is, you should have things organized and people should know where they are and what the most up-to-date information is. And a lot of, with a lot of my clients, I have a copy of their up-to-date will or an up-to-date copy of their power of attorney or trusted contact that I've got on file. So if I know something's has happened, that I know where to get that information. And nobody can act on anything until a will has been located, and then even distribution of assets then becomes a whole process, which is called probating of the will in most circumstances. So it's a conversation that most people should have and that children should know where information is. The last thing is that you really want to have is surprises at the end that you can't find something.
Good point.
And that's a very growing area in the legal sector is estate litigation, because there is a lot of there's not enough clarity as to what was supposed to happen, where things are, what promises were made, and that's just by families not doing what they needed to do ahead of time.
Right. So communication is very important. Perfect. Thank you. So last question, when is it advised to leave a percentage of the estate rather than a specific amount?
So I'm happy to start here. So to me, it's not that there's one that's advisable or less advisable. I think it's a decision to be made by the individual about what makes more sense for them. And so if it is important for you that you know the exact amount of the donation, that will be a dollar amount, because you make your will at a certain point in time, but that's not the day of death, right? So that could be a year away or 2 or 5 or 10 or 20. So if if your estate today was worth $100,000 and you wanted to leave a gift of $20,000 and you said, okay, so I'm going to leave 20% of my estate to charity. Well, your estate could be valued at $1 million 10 years later or less. And so if certainty of the dollar amount is important, that's where a dollar amount gift would be advisable. If you're comfortable to say, regardless of what the value of my estate is, I want 10% of that number to go to charity, that's where a a percentage can make sense. So it's really about personal preference and what someone is trying to achieve. And just understanding, I think the fluctuating value of your estate is really important, so that on the day you make your will, I mean, the same thing applies not just with charities, but with individuals. So understanding, if you're leaving a particular dollar amount gift today, that will continue to be the exact dollar amount if you pass away in 10 years or 20 years or 30 or more. And if you're leaving a percentage, you have to know that there isn't the certainty around what that gift will end up being in the future.
Good points. Thank you. That's great. There was some comments made by one of our participants who suggested that as part of the organization of all your documents and communication to your family, you should also provide them with a list of your passwords to computers and tablets, phones, bank accounts. That all should be passed and included as well with your important documents. So that's great advice, and thank you to our participant. At this
Can I make
point,
one comment on that?
Yeah,
I've heard some people say that it's important to put passwords and stuff like that in your will or things like that. So just a reminder, your will becomes a public document after you pass away. So that is not the place where you should be including passwords. It's also not the place where you should be including, for the most part, like specific investment accounts or bank accounts, like those sorts of details or information. Those things generally don't go in the will. And with passwords, I'll also say this is a bit of a gray area. And an area that I think there's still there's a lot more progress that needs to be made in this area, because strictly speaking, in terms of the terms of service with an organization, you agree not to share your passwords. Practically speaking, it is the only way for most people to access your computer or your Gmail or other accounts is by knowing what your password is. But you're not supposed to be sharing passwords. And so I don't have any concrete recommendations, but just to understand there's some challenges in that area. So practically speaking, it's still the way that most people do it, is to share passwords to accounts that someone otherwise wouldn't be able to access. But I do suspect that over the coming years, that will change in a way to make it more secure.
That's also technology is enabling. There are portals that are set up directly for estate planning purposes of that aggregating of information for family members. So it's not, that slowly is coming on stream for people. A lot of the challenges are that the generation of the 70s, 80s and older maybe are not that technologically savvy. But there is technology coming, and fortunately, the generation that was 20 years earlier is now quite technologically advanced, and it doesn't have as much challenges as maybe some of the seniors do today. The other thing I'll also caution is that a lot of people go and decide to put things jointly in their names, and this is also a big pitfall and can be a big challenge. By putting bank accounts jointly in names and other things, it creates or could create a lot of family fights. There's reasons why people do it, and I'm not subscribing to say that it's a good idea, bad idea. I'm just saying it can be very poorly received in a lot of instances, and there's a lot of challenges that come with it. And I'm sure Daniel can also share with you after that there's been some horrific stories that have happened, but it becomes unintended gifts sometimes. It creates a huge amount of litigation liability. It becomes, if somebody has a joint bank account with another family member and they get sued or they get into a marital breakdown, there's a whole bunch of pitfalls that happen. So those are some of the things that you just need to note and carefully think about what decisions you make in order to I call plan. And a lot of people are making those plans because they think that they're saving tax, but on the flip side, it's done in a moment in time, and they may be living for a very long period of time. So just as a heads up.
That's great advice. Thank you very much. Before I turn it over to Elena to provide some closing remarks, I just wanted to mention and reiterate that Daniel Goldguts, a partner of CHW, we have a page up on the epilogue.com website If you're looking to create a will, it's a great first step, especially if your will and your estate plans are not complicated. So I invite you and encourage you to visit Epilogue. Is that the correct URL? Epilogue.com.
So maybe the best thing to do is to send out an email after, because that way it will include all the necessary parameters to make sure that everyone ends up on the right page, on the CHW page, and then that way when they go through the process, we'll sort of benefit from that experience, and also there's a discount to anyone that comes in from that particular page. So yeah, maybe best to share that specific link.
That's great. And in addition to sending out that information, we're also going to send out contact information for both of our Daniels. So if you do have specific follow-up questions or you're interested in engaging in their services, you can contact them directly. So on that note, I'm going to turn the microphone over to Elena Latsky with some closing comments.
Hi, and thank you, everyone. I hope you enjoyed today's webinar and increased your knowledge about legacy giving and the life-changing impact a gift can make for CHW. Over the past year, CHW implemented several significant changes to refresh our brand, launch a new website, increase our profile in the community, and attract a new generation of donors. One of the recent changes was to enhance our Legacy Circle program, which includes more recognition and benefits for our generous donors. In fact, coming up next month in October, during the inaugural Journey for Impact trip in Israel, Marla Dan, as our national chairperson, will cut the ribbon to inaugurate the CHW Legacy Circle Garden, which commemorates 100 years at CHW Nahalal Youth Village and recognizes Legacy Circle members who have passed on. Our Legacy Circle program ensures that a fruit tree will be planted in memory of all donors who become a memory of the Legacy Circle. As an organization with such a rich, long history, our mission to empower women and children will never waver and continues to grow stronger. Everything we do, everything we have achieved continues to propel us forward. Legacy giving ensures that CHW will support Israel and Canada for another 100 years, and with that, the impact on future generations. I hope that you will join me and many other dedicated and passionate CHW supporters who have included CHW in their estate plans by making a commitment and signing a letter of intent with your planned gift to CHW. It is very easy to do. Contact Lisa to discuss your interest, and she will work with you to help you fulfill your philanthropic goals. Our heartfelt appreciation to Daniel Goldgut, Daniel Glazerman, and Jorge Diener for your interesting and informative presentations. And finally, thank you to all of you for joining us today. But before you go, I want to remind you of two important upcoming events. The first is the launch of the CHW Social Impact Fund and Investing Dragon's Den Experience, taking place in Israel on October 27th and live streamed over Zoom. This event is open to the entire CHW family and will be the start of an innovative and sustainable impact initiative geared at empowering women. To get in on the action and be a judge, visit our website or contact Lisa. Also, please save the date for our annual general meeting and national board installation taking place in Toronto on November 20th. You are all welcome to attend in person or over Zoom. Details about the event and how to register will be emailed soon. This concludes today's program. Thank you, see you again soon, and Shana Tova to you all.